Hey, good morning, everyone. Marty Mazzora here, May 4th, 2022, Wednesday, with your midweek market snapshot / technical update. So, folks, I'm going to try to continue to keep these quick. So I don't want to get deep into the macro weeds. There is a lot of that on the written blog. So if you're not reading those and you're interested, please do. That's where we get to the really meaningful, fundamental macro, economic stuff that we think is the tide of the market. The technicals are akin to the wind. Are the technicals lining up with that tide, so to speak? We think both matter, and therefore we do both. In front of you is the 60-minute, 60-day chart for the S&P 500 to get just a really short-term look at what the market's doing and what the charts are suggesting. And recall, I'm sure it was the last one, we had this falling wedge pattern and we had a bullish divergence, and that played itself out. We broke out above it, got a little bit of a rally here for this many hours. Each candle is an hour. And now what we have is quite the channel. If we connect these 2 points, we now have enough for a downtrend line, and then we have the support underneath here. And but we still have these bullish divergences. So on that, right here, you need a breakout above this downtrend right here, and then you have a buy signal if you're apt to trade this thing on a very short-term basis, which is not my recommendation. Now, if the Fed disappoints the market today and says what's expected, and that's a 50 basis point increase and an announcement of the pace they're going to allow their balance sheet to decline, but it's really the follow-up commentary in Jay Powell's press conference that the world will be clinging on. And if he continues with the hawkish rhetoric, please read today's morning note where I talk about that. I think the market stands to be very disappointed. And if we break down below that and we lose these bullish divergences, that's very negative in the short run going forward. Looking at the 1-year daily chart, we have a few things going on here. We have this bear flagging action. As you can see, this one played out virtually to a T. That's a very textbook bear flag right there. And what you do is you take the flagpole, you take it to the top of the consolidation right here, and move that down for your next target. That's about where we came in here. And then we formed another flag right here, very classic. And so that would take us right down to this very round number, 4,000. Although on the momentum indicators, like on the hourly, we do have real bullish divergences, right? So this suggests there could be some upside, that odds are leaning towards this flag not playing out and a move higher. It all depends on what happens late this morning, West Coast time, during Chairman Powell's press conference. Taking a look at the weekly chart, this is a bearish look, folks, where the MACD started to see a gain in momentum and then failed it before the buy signal and rolled right back over. This pattern up in here, and I'll zero in on that, the losing of the 50-week moving average, failed retest, momentum, big bear candles, these are weekly candles, on the way down, are a pattern that has, over the past 30 years or so, virtually without exception, culminates in at least a test of the 200-week moving average, which would take us down another 16% from here, or about a 30% year-to-date decline. And then on the 30-year monthly chart, we have something that is decidedly not pretty. This is the one that of them all concerns me the most, I must say, because when we have these MACD sell signals, when the MACD line drops below the signal line, which is the red line, not good things tend to happen. Now, we had just barely a sell signal right here, which was when, ironically, in 1998, Russia defaulted on its debt. We had a currency crisis in Asia. The largest hedge fund in the world went belly up, and the S&P went down 20%. But when the sell signal took and we actually rolled over, without exception, we came down and either broke or tested the 50-month moving average, right? And the 50-month moving average is a 200-week moving average, what we're talking about is about a 4-year time frame. So this number corresponds with that 200-week moving average. And here we're further above ground, if you will, further above zero. We have a real negative divergence in the RSI, the Relative Strength Index, and we have a serious sell signal here on the MACD. Therefore, the chart says, we have that 16%, 17% left to go, which should be about a 30% decline in the S&P 500. Folks, again, these don't have to play out. I'm being redundant. I keep showing you these every time because these are the things that we're looking at and are inspiring some of our defensive, hedging moves and some of the things that we're doing. Because, the technicals are lining up with kind of the thin ice fundamentals that we see right here. Today's going to be telling, of course. If the Fed is concerned about this and doesn't want to disappoint, even just something slightly less hawkish would either not tank the market or, could see it rally right here. I have no predictions on what's going to happen this afternoon. And this afternoon, of course, is meaningful from a policy perspective. In the long-term scheme of things, as I illustrated in the graph that I featured in this morning's note, these blips are utterly inevitable. And if you're going to be in the market, at least with a portion of your portfolio, get used to it. Clients, those of you who are 100% exposed to our core portfolio, which is virtually all of our clients, save for, to some degree, those who have placed some constraints on them, which would be usually around taxes. Usually it's embedded capital gains that they don't want to pay taxes on all at once, that sort of thing. But nevertheless, what we're doing is we're hedging using options against something dramatic to the downside. That does not keep us from correcting. At the same time, we're owning some gold. We are tilted toward structural inflation going forward, resource stocks. There's going to be a lot of infrastructure spending in the years to come, probably a ton of it coming up relatively soon in China, which is very bullish for the commodities that we're in. And then, the global push to green energy is very taxing on global resources like copper and so on. So we want to be in those spaces for the long term going forward. And they can be in volatile spaces as we experienced in April along the way. But again, that's something that I pointed to in the macro videos to expect, that parabolic move in commodities was not sustainable and that we would absolutely see probably some serious corrective action. And we saw some of that this last month. So folks, I'll leave it there. Longer than I expected, but hopefully that was interesting and to some degree useful to you in terms of you gauging your expectations if you're watching this market closely. Have a wonderful rest of your day, and I'll talk to you again very soon. Take care. Bye-bye.